Over the years, you've heard me ask wealth manager Warren Ingram the big questions. How do we invest wisely? How do we protect our family's future? All those conversations, that entire library of financial expertise is now available as a podcast. Straightforward advice to help you build your wealth on demand. Just search for Warren Ingram's Personal Finance wherever you get your podcasts.
The Money Show.
Personal Finance with Warren Ingram.
Well, you've heard throughout the show and really for the last couple of weeks so much around what is actually changing coming out of Washington. So we're expecting a big tariff decision that will affect us on Friday, we expect. But there are other issues within that. We know that the US president prefers a weaker dollar, and the dollar has, by and large, been getting weaker over the last sort of year or so, certainly over the last 6 months or so. So what does all of this do to you? What does US government debt? What impact does that have on you? Warren Ingram is the co-founder of Galileo Capital. Warren, it's been a little while. Good evening. Welcome back.
Thank you so much. It's great to be on the show again.
So we've seen tariff and trade agreements being signed by the US president. Some are getting quite punishing tariffs. We have the big, beautiful bill, which is really going to affect the US government's levels of debt, and that, in fact, that might be quite unsustainable. In fact, they'll just never be able to pay it back. I realize it's a big question, and I suppose most people will have money invested here, there, and kind of almost everywhere if they've diversified properly. What does this do to our investment portfolio?
It's so interesting, Stephen. It's probably the question I'm being asked the most at the moment. And, you know, if you think about how much we have to deal with in South Africa and the political uncertainty and instability we've got, it's always fascinating to me that, most investors are externally focused and very particularly now around Trump, how he's unsettling the world, and people have very strong opinions about him. I think one thing is it's extremely difficult to be neutral about the man. You either love him or hate him. And to me, I always think we had a much tougher time, this time a year ago, trying to understand how our country was going to deal with, the big kind of change in elections and all of that. And where we are now, it feels to me we're in a much better position, but fear levels are quite high. And so maybe we need to get into understanding, when we're in a world that is increasingly uncertain, and I think that's a very accurate statement. The world's always been unstable and uncertain, and we need to know that uncertainty and instability is an investor's best friend. If everything is very stable and everything's going up and markets are doing well and everybody feels calm and confident, it means that asset prices are probably very high. And if that's the case, there are no bargains to be had. So if you're an investor, you should be looking at the world and saying, I hope every now and then that the world offers me an opportunity to buy great assets at a low price, and that's what instability is. So
okay.
If we're
I'm not feeling like that right now. I'm feeling quite scared right now.
Yeah, and so now we've got to bring out the sage of Omaha, the real Warren Buffett, and put on our fireman's suit. And he always says, you've got to be able to run into the burning building when everyone else is running out. And it's counterintuitive. It's not human nature to be contrarian, but that's really what you have to do. And I'm not saying you need to be an economic guru, because just understand, when we talk about economics, if you're going to make investment decisions based on forecasts, and forecasts are just an economist's way of talking about predictions, and if you're going to make your big decisions around a forecast, you have to do a lot of things right, in fact. The first one is you have to be correct in your economic prediction. So you have to say, Trump's tariffs are going to be terrible for the world and everything's going to fall over. So you have to get that right. And by the way, I'm not making that forecast, but that's the first thing. Then you have to anticipate what other investors have done and how they are going to make decisions around that prediction, and did they get the prediction right or wrong. And then you have to position your investments for all of those decisions to fall like dominoes, in a line, and then you might profit from that outcome. I would argue that's pretty close to impossible. It's probably much easier to predict the weather than it is to do that. So my first thing is, let's not get caught up in the big economic predictions. And there are people making very confident predictions that the US is, bankrupt and it's going to run out of money. Trump's going to, impose tariffs that are so high that trade will just stop. And everyone except America will suffer, or other people saying that Trump's going to destroy America. And all of those are, people make very strong arguments, but an argument that's made with conviction doesn't mean anything. It has to be made with good facts, and with a very strong possibility that the opposite of whatever is forecast is there. So I'm going to say it doesn't really matter. And I'm not being flippant. I'm just saying we can't forecast. We can't predict. Economists aren't right even 50% of the time. So how on earth can we make long-term investment decisions based on that? So I'm going to say for everybody listening that's panicking, and it seems to be quite a high proportion, I'm not disregarding that the world's in a very uncertain state. What we need to know is the world's been in this type of situation many times before, and investments continue to grow. The people that benefit are those that stay invested. The people that don't benefit are those that buy all the very strong conviction forecasts and then sit on the sidelines, or do the very opposite of what they do. They start to trade and they start to get caught up in the hype. And I think we've got to just say, listen to those forecasts. They're interesting, like your weather app is interesting, but you can't rely on it. And, if it says it's not going to rain in Cape Town tomorrow, don't take your raincoat. That's crazy, because it's Cape Town in winter. It's probably going to rain. So take your raincoat. And that's what I mean around these investments. Don't now bang on about forecasts as absolutely reliable. They're the exact opposite of absolutely reliable.
I mean, it's such a complicated thing around sort of forecasting. So one of the things that we're seeing right now, and I mean, this is a major change in the world, is that the dollar is getting weaker. And this is partly kind of almost deliberate. Trump has said he wants a weaker dollar. Now, it makes the rand look a little better. We still end up having to pay for oil in dollar prices, so it just sort of goes up in dollars. So we need to be, not sort of look at it and feel better about ourselves necessarily. But how do we then sort of how do we assess our investments if the dollar is getting weaker?
It seems the core question that's worrying a lot of people. The other question that adds to this is, are we seeing a situation where the world is moving away from the US dollar as a reserve currency, and is that accelerating, the drop in the dollar? I think it's important maybe just to zoom out a little bit. So the dollar is too expensive. If we measure the dollar, there's actually a very nice index of the dollar versus all the other trading currencies, and it's called the DXY, the Dixie. And if you look at a graph of the Dixie, you can put it in Google and have a look. You'll see that it's been going up and up and up for quite a long period of time. So, like any type of asset, it can't only go up for long periods of time. At some point, it must come down. And that's what's happening now. Whether Trump is succeeding in doing that himself, or whether he's kind of climbing on the bandwagon of an overpriced asset, I'm not sure. But the people that will lose out, I think, if the dollar gets very weak, would be let's say South Africans who've taken their overseas investments and put them all into American companies that only sell products made in America. Because let's say you manufacture whatever it is, some gizmo, the likelihood is you're importing some of the components that you need and you're manufacturing the rest in America, and then you're putting them all together in the US. Tariffs are going to hurt a company like that because some of their parts are going to be much more expensive, and they're still paying their labor prices in the US and selling the product to Americans. So what's happening is their costs are rising because of tariffs, and also because they're now, if they're imported, let's say from Europe, if the dollar is weaker against the euro, it means that their product is weaker or more expensive because of currency and tariff. So they're in trouble. However, if you're a multinational like Microsoft, you sell a heck of a lot of services all around the world to many, many countries and companies far away from America. And guess what? You don't make a lot of stuff. You don't import labor at a euro rate and then put them at a computer in America, you've got developers and staff all around the world. You've got data centers all around the world. So a weaker dollar might mean that Microsoft will report more earnings because all of a sudden it's earning more euros, it's earning more yen, it might even be earning more rands. And so I'm not sure that a weak dollar is necessarily a bad thing for multinationals, especially those that are very well spread. So now we sit here in South Africa. Sorry, Stephen.
No, go on.
So we sit in South Africa and we say, well, gee, what happens if the dollar really crashes? If it really weakens against the euro and the pound, etc. I think if that happens, it doesn't mean that we're going to watch the dollar go from 1780 or 1790 to 12 rand to the dollar. I think what happens is if we see the dollar getting very weak, it's going to cause a lot of uncertainty. People will be really worried and they will pull money out of emerging markets, which is what always happens when they get afraid. And so the possibility is that the rand actually weakens. And so you might be seeing that the rand acts as a bit of a shock absorber, and your investments, the overseas investments that you have, when you price them back into rands, actually not so bad. So I think we've got to be very careful that a weak dollar is not just a bad sign. It might be actually an okay sign, as long as it doesn't get too far. The pendulum doesn't swing all the way across.
And the thing is that over the last 12 years or so, quite a lot of money has flown into the US, even from South Africans, simply because that was the best place to put it. So, I mean, this is quite a big reversal for people who put money there.
It is, and isn't that a good sign? Isn't it a good thing? Because we don't want one asset or one country or one share or something to attract too much money, because then the world goes into an imbalance, and we see countries outside of the US maybe doing well, or companies outside of the US doing well, but being incredibly cheap. And I think you could describe South Africa as one of those. And so they get less and less money, even though they're well managed, offering good prices, good profits, and all of those things. So I think money moving out of the US again, and into emerging markets. We are seeing a flow of money, going back into emerging markets once again, but also into places like Europe and Japan and the like. And I don't think that's a bad sign, because those are very, Japan is a well-run economy, great businesses in there. They should be rewarded for good growth and good profits. So as long as we see the pendulum not swinging too far, I think one thing to understand about the investment cycles is that they never stay in the middle and they never stay neutral. So at the moment, it went too far to America's favor. Now it's swinging back. It's still got a way to go, and it might swing a little bit too far. The dollar might get a little bit weak, and maybe a little bit too much money flows out of the US. But it's extremely unlikely that the entire world decides we're not buying Microsoft and Apple and all the big American companies listed in the US anymore. That's very unlikely. What might happen is those share prices might go down for a time, and then people are going to go, you know what, I can buy no big tech company in South Africa. I can buy Microsoft in the US, and it's got a dividend yield of 12% as an example. I'm going to buy that because it's a great opportunity. So the pendulum will swing back again. So that's what always happens in markets. It's just our patience levels that run out.
We're speaking to Warren Ingram, co-founder of Galileo Capital, tonight on personal finance. We have a question from June saying, hi, I'm going to retire in the next 3 months. I'm not sure what to do. I'm being offered different recommendations by different financial advisors. How do I decide which one to choose? Too much advice, says June. We'll get an answer for you in a moment.
The Money Show.
Personal Finance with Warren Ingram.
He's the co-founder of Galileo Capital. Good to hear your questions this evening as well, of course, on 011 8830702 and 021 446 0567. Warren, June's question, she's retiring soon. She's getting different recommendations from different financial advisors. How do you decide which is the best?
It's so tricky. I empathize, June. It feels a bit the same to me when I go to a specialist at the doctors and they spew all this jargon at me, and I have no idea who's a good one and who's a bad one, and all their certificates on the walls look the same. So here's some principles you can potentially use to make a decision. The first one, and it might sound obvious, but it is a key, is fees. If you're retiring, that means you're going to have a retirement fund and potentially some other investments that will need to start looking after you. You're going to need an income from those. And so you want to be charged a reasonable and fair fee. You don't want to overpay because high fees will erode all of your capital and compromise your lifestyle. So I would say, make sure that they're not charging you any upfront fees on investments. I think that for me, that's a big no-no. It's not right at all. And if you've got, let's say, a retirement fund, which might be a living annuity, you're going to pay some investment fees, you're going to pay some admin fees, and you're going to pay some advice fees. All of those fees together need to be around about 2%. I think 2% and lower is your benchmark. If someone's quoting you 3%, it's too high. I can't see a reason that you would pay a fee like that. So I think fees is a big one. And then they need to explain clearly and very simply in a way that you will understand how much money you're going to lose when the next big market crash happens. And that could be tomorrow or it could be in 5 years' time. None of us knows. But they need to explain it to you and to say, if you've invested 10 million Rand of your retirement fund in a big market crash, you could see your 10 million Rand bottoming out at 7 million Rand. Whatever the number is, they need to explain it to you. They need to explain why. And you need to be prepared for that. You need to be psychologically and financially ready for that. If they're not explaining that to you, that means you're not prepared for when the world falls apart. And the world falls apart many times every few years. And so you have to be ready for a situation like that. I think
go on.
The next one will be around income. A lot of the time, if you're getting advice from an advisor and you're retiring, you're going to say, I want 50,000 Rand a month. And so the advisor does everything they can to give you 50,000 Rand a month. But what they need to do is say, you can only afford to draw 35,000 Rand a month. You don't have enough capital to draw 50,000. And your benchmark there is the value of your investments and the income that you draw as a percentage. In other words, if you've got 10 million Rand, they need to say to you, the maximum you can draw is 5% or less from your investments. That's sustainable. If someone says you can draw 8% a year at the start of your retirement at age 65, they're just making you happy, but what they're doing is giving you huge troubles later in life because you're going to destroy the value of your money. So I think that those are the mechanicals, Stephen. And then the last one is, have they explained it to you in a way that's simple and understandable with no jargon? And can you take that recommendation and explain it to someone else who's not a financial person? If you feel that you know your recommendation well enough and you can explain it well enough, then you're in a position where you've been empowered to make a good decision. And that advisor needs to explain it to you so that you feel confident and in a way that's done with you not feeling spoken down to or condescended to. If you feel silly asking advisors questions, then it's not your fault, it's the advisor's fault. They haven't created an environment that you can ask what might be simple questions. And I think that for me, that's always a chemistry test. If I feel intimidated by the person, that's not me, that's the person who's not doing a good job, who's giving me the recommendations.
Okay. Yeah, very helpful. Thank you. I think a lot of people are thinking about that at the moment. We've got 2 minutes left, Warren. In the situation that we're facing with the tariffs, the weakening dollar and all the rest, what do you do with your investments? I kind of know the word you might start with.
I think stay calm and understand that a lot of what you own are actually going to be shares in businesses both in South Africa and around the world. And whatever happens in the politics and the trade and tariffs and all of that stuff, understand that those managers of those companies are not static. They're going to look at the world. They will adapt their businesses. They'll adapt the way that they run and trade and all of those things to get with the new environment. And so there might be some turmoil in the short term, but over time, they will recover and they'll continue again. And then make sure that you spread your investments far and wide. And please don't go and buy today's top performer. If it's NVIDIA and it's doubled and doubled for the last 3 or 4 years, it's probably too expensive. Rather spread your money. If you don't know what to do, just buy an index or a global equity fund and buy a combination of those. But when you don't know, spread your investments nicely and then just don't panic. This too shall pass and there will be new things to worry about. But guess what? Markets go up and they are rewarding to patient investors.
So basically you keep calm and carry on investing.
Exactly right.
So I mean, it's interesting that businesses adapt because the big question, of course, is how quickly they do that. You don't always know what's going to happen, but that really requires you to trust the managements and then to also know that they are going to do something. They're not going to sit still and do nothing. And sometimes it can feel, oh, we're just going to sit here and this wave is going to break over us, when in fact we're going to react to the wave too. And that's what companies will do.
Yeah, they do. And you know, if you look at, one of the big fears was around AI and how it's going to destroy a whole lot of companies and create new opportunities. And that might be true. But the reality is it's also a tool that many companies and with good management teams will look at and say, we can adapt and use these to make ourselves better and faster and more profitable, etc. It's not always just doom and gloom. And if you don't know which are the good management teams, then buy all of them. In other words, buy the global index, buy the top 50 index in South Africa. Then you get a massive spread of companies where you might have some bad management teams that don't adapt, but the likelihood is you'll get some average management teams and some exceptional ones as well. And all you need to do is exercise patience. I say it as if it's easy, Stephen. It's very hard to be patient and to be calm, but that is the thing to do.
Warren Ingram, thank you so much. Really appreciate it. Co-founder of Galileo Capital and, of course, with Personal Finance this evening. Keep calm and carry on. What's the reminder of that phrase? They say in markets, nothing ever happens. I mean, it's not entirely true, but you kind of know what they mean.